Welcome to the Deep Dive, where we take your complex sources and really unearth the most valuable insights, giving you a true shortcut to being well-informed.
Exactly.
Today, we're undertaking a deep dive into the recent financial and operational performance of the Progressive Corporation, a major player, obviously, in the insurance industry.
That's right. And for this deep dive, our analysis, it draws directly from their detailed Form 10-Q
Okay.
and also a complimentary news release. Both cover their second quarter ended June 30th, 2025. So, yeah, it gives us a pretty fascinating look behind the curtain.
Definitely. Our mission here is to unpack Progressive's key financial metrics, really understand the strategies driving their business segments, explore their investment approach, and maybe even glimpse the corporate culture shaping their success. So what does this all mean for you listening?
Well, you're about to get a comprehensive understanding, really, of how a company of this scale manages to consistently deliver such strong results, especially in, a really competitive market.
Yeah.
Exactly. So when we look at the big picture for Progressive in Q2 2025, their CEO actually described their performance as a trifecta.
A trifecta, okay.
Yeah, and this isn't just like a catchy phrase. It signals genuinely robust financial health
Right.
and operational efficiency, too. It shows they're not just growing, but growing profitably.
Okay, so let's unpack this trifecta then. First up, net premiums written, or NPW.
Right.
For Q2 2025, the company saw, what, a 12% increase year over year,
Yeah.
getting over $20 billion.
Yeah, huge number. And year to date, that jumps even higher.
Up until
15% increase, totaling more than $42 billion. That's, serious top-line growth.
Absolutely. And what goes hand in hand with that, I guess, is net premiums earned, NPE.
Exactly, NPE. For the second quarter, that saw an 18% increase,
Okay.
reaching over $20.3 billion. And year to date, it was up 19% to nearly $39.7 billion.
So these figures really highlight their, I suppose, ability to convert those written premiums into actual revenue effectively.
That's it. The money isn't just promised, it's realized.
Got it.
Yeah.
And it's not just about the money flowing in, right? It's the customer base expanding too. Policies in force, PIF.
Yeah, PIF grew significantly, 15% year over year,
15%.
bringing them to over 37.3 million policies company-wide. And get this, they added nearly 1 million policies in Q2 2025 alone.
Just in the quarter. How does a company even manage that kind of scale?
It's a huge undertaking, isn't it? And it really speaks volumes about their operational efficiency. And the underlying profitability is just as impressive. Their combined ratio for Q2 2025 was strong, 86.2%.
Okay, maybe just quickly remind us the combined ratio.
Yeah.
Lower is better, right?
Exactly. It's basically all their expenses claims paid out plus operating costs as a percentage of the premiums they earn. So yeah, lower means better underwriting profit.
So 86.2%, how does that compare?
Well, it's a big improvement, 5.7 points better compared to 91.9% in Q2 2024. That's a significant leap in efficiency.
Okay, so we've covered growth, premiums earned, policies, efficiency. Let's talk bottom line, net income.
Ah, yes. For Q2 2025, a massive 118% year-over-year increase,
118%.
reaching over $3.18 billion.
That's just a huge leap. In your analysis, what was the primary driver or drivers behind that kind of explosive growth?
That's a great question because, yeah, it's easy to get lost in these big numbers. I'd argue it's their relentless focus on, data analytics.
Okay.
And precise segmentation combined with strategic rate adjustments. It all comes together.
So the policy growth.
Yeah, the policy growth, converting premiums to earnings effectively, that impressive underwriting profit.
And the net income.
Right. It all points to a well-executed strategy and highly efficient operations. It allowed them to capture market share and improve their claims profitability at the same time.
Instead of one at the expense of the other.
Exactly. It seems like a very calculated approach, not just a sort of blanket grab for market share.
Fascinating. So profitable growth, not just growth for growth's sake.
That seems to be the story.
Okay, now let's peel back the layers a bit. Their underwriting operations, starting with personal lines.
Right.
This segment covers what? Personal autos?
Yeah, personal auto, which, by the way, makes up about 90% of this segment's net premiums written. So huge.
90%.
Then you've got special lines like motorcycles, RVs, boats, that kind of thing, and personal residential property, so home insurance.
So how does Progressive keep this momentum going while, navigating all the challenges in such an unpredictable market?
Well, in personal auto specifically, the growth drivers seem pretty clear. They saw a 16% year-over-year MPW growth
16. Okay.
and a 19% increase in policies in force.
Wow.
And this was attributed mainly to increased ad spend.
You see their ads everywhere.
Right, competitive pricing and also specific efforts to engage independent agents. They're really leaning into customer acquisition from multiple angles.
And it seems like those efforts are paying off. New personal auto applications were up 8% in Q2, while renewal applications jumped, what was it, 22%?
A massive 22%, yeah.
And, quote, volume was positive too, right? Up 7% in agency, 2% in direct.
Correct. And conversion rates improved as well, about 4% year-to-date in agency, 6% in direct. So yeah, the funnel, as you say, seems to be working pretty well.
No, when you break down their consumer segments, this gets interesting, doesn't it? With the Robinsons and Sams.
It really does. It reveals some strategic dynamics. Progressive uses these categories, Sams, Dianes, Wrights, Robinsons, to segment policyholders based on insurance history and home ownership.
Right.
And it's not just internal jargon, it's really central to their underwriting.
So what did we see this quarter?
Well, we saw underwriting restrictions in personal property hitting the Robinsons. Those are the bundled auto and home customers, particularly in the agency channel.
Okay, so fewer new applications from them.
Exactly. Declines in new apps, quotes, and conversion for Robinsons through agents. But in contrast, Sams and Dianes saw growth.
So what does that tell you?
It signals a deliberate choice, I think. They seem to be prioritizing profitability, maybe pulling back slightly on riskier bundles, even if it means sacrificing some of those cross-sell opportunities.
So a strategic trade-off. Laser focus on risk selection.
Seems like it,
Yeah.
even if it impacts those bundled Robinson numbers.
Makes sense. And speaking of rates, personal auto rates were, what, relatively stable in Q2?
Yeah, pretty stable overall. There was actually a slight decrease in the written premium per policy,
Oh, why was that?
mostly due to some targeted rate reductions in certain markets. They mentioned Florida, for example,
Ah,
and also a mix shift towards more 6-month policies, which naturally have a lower written premium per transaction than a 12-month policy.
gotcha. What about retention? That's always crucial.
Absolutely. On that front, the trailing 12-month policy life expectancy for total personal auto, it actually saw a 5% year-over-year decrease in Q2.
Okay, so people aren't staying quite as long. Why?
Yeah. Progressive points to a few things. Mix shifts in their customer base. Increased shopping around by consumers. People looking for deals.
More competition.
And more competition in the market. Exactly. Suggests customers are definitely more price sensitive or comparison shopping right now.
And a key part of their strategy for, like, rating accuracy is Snapshot, right?
Yeah.
Their usage-based insurance.
Yeah, UBI. Snapshot's a big part of it. It's available in most states, though not California.
How's adoption looking?
It's a bit mixed. For Q2, adoption rates decreased slightly, about 2% in the agency channel,
Okay.
but increased 6% in the direct channel. So more direct customers opting in.
Interesting split.
Yeah.
And they rolled out a new version.
Yeah, Snapshot 5.0. And the interesting thing here is it apparently includes accident detection.
Oh, wow. Okay, that's a significant tech advancement.
Definitely adds value beyond just the potential discount.
Okay, let's shift to personal property then. Homeowners, renters, what's the focus there?
Yeah. Profitability. Squarely on improving profitability and reducing exposure, especially in those volatile, weather-prone markets.
Coastal states, hail states.
Exactly. Think Florida, Texas, places like that. So they're prioritizing lower-risk properties.
Like new builds.
Yeah, new construction, homes with newer roofs, things that are less likely to have major claims, and implementing bundling requirements in some areas.
But also restricting some property types.
Right. Restricting non-owner-occupied properties and also expanding cost sharing through things like higher deductibles and roof depreciation schedules, basically making the policyholder bear a bit more of the risk for certain things.
And the big one in Florida, the non-renewals.
Yeah, that was significant and pretty well publicized. They aimed to non-renew about 115,000 property policies there.
And that's done now.
The report says that effort was largely completed by the end of Q2 2025. It's a really bold move, shedding that unprofitable risk.
But these actions must have had an impact on growth.
Oh, definitely. An adverse impact. New business application growth in property was down 11% for Q2.
11%.
And similarly, the trailing 12-month policy life expectancy for personal property dropped quite a bit, 17%.
Wow. Why such a big drop?
Mainly due to that mix shift, more renters policies, which tend to have shorter lifespans anyway,
Right.
plus the impact of rate increases and, of course, those non-renewals kicking in.
They did take rate increases, though.
Yes, they implemented a 4% aggregate rate increase in Q2, which brings the total over the trailing 12 months to 14%.
Okay.
And they're deploying new product models, these 5.0 plus models, presumably to better match rate to risk, still actively adjusting.
No catastrophe losses. Always a big factor in property insurance. How did they fare in Q2?
Actually, catastrophe losses saw a decrease in Q2 this year compared to Q2 2024.
Oh, really? Despite all the severe weather we hear about.
Yeah, despite severe weather events across the U.S., they mentioned Texas, for example, accounted for about one-third of their Q2 cat losses.
But how did they manage to reduce losses overall?
Well, a big factor was favorable prior year reserve development.
Meaning money set aside previously turned out to be more than needed.
Exactly. About $607 million favorable development for the first 6 months of 2025.
Where did that mainly come from?
Mostly personal auto, interestingly. Driven by lower severity and frequency in Florida, they explicitly mentioned tort reform there.
Ah, the legal changes.
Yeah, leading to lower litigation costs. And also some favorable development from commercial lines, too.
Okay. And you mentioned their reinsurance programs earlier, kind of a safety net. Can you break that down a bit?
Sure. They have a pretty structured approach. For personal property outside Florida, they keep the first $200 million of losses. That's their retention.
Okay.
In Florida, it's lower, $75 million retention. Then above those levels, they have reinsurance coverage up to $2.0 billion.
That's substantial coverage.
It is. Plus, they added a new type of contract for 2025, an aggregate excess of loss contract.
Aggregate, meaning it covers total losses over time, not just one event.
Precisely. It has multiple layers. The first kicks in after total losses, hits somewhere between $450 or $475 million. The second layer after $525 million.
Interesting. And there was something else specific.
Yeah, a severe convective storm parametric coverage.
Parametric, what does that mean?
It's pretty cutting edge. It pays out automatically if certain predefined weather parameters are met, like, say, hail of a certain size hits a specific area or wind speeds reach a certain level.
Without waiting for individual claims to be filed in a second.
Exactly. It provides quicker liquidity after a specific type of major event. This one provides $15 million of coverage, but it has a high attachment point, $665 million retention.
Wow. So this whole setup, what does it tell you about their risk management?
It shows a really sophisticated, multi-layered approach. They're not just buying standard reinsurance. They're fine-tuning their protection against both individual large events and the accumulation of smaller events, and even using advanced tools like parametric triggers. Very detailed risk transfer.
Makes perfect sense. Okay, so while property risk is carefully managed, let's swing back to personal auto trends. Severity and frequency. What's happening there?
Okay, incurred severity, the average cost per claim that increased by 6% year over year for Q2.
6% increase. What's driving that cost up?
It was predominantly driven by higher reserves needed for bodily injury coverage.
Ah, injury claims costing more.
Yeah, due to increased medical costs, which we're seeing broadly, and also a higher rate of litigated injury claims. That's a trend across the industry, really.
Okay. And conversely, what about frequency? The number of claims.
Frequency actually decreased by 4% year over year in Q2.
Down 4%. Why fewer claims?
They suggest it reflects a mixed shift in their book towards a more preferred, lower-risk customer tier.
Okay.
And maybe lower vehicle miles traveled overall. If people drive less, generally there are fewer accidents.
Right. But it's tough to predict these things going forward, isn't it?
Oh, definitely. They acknowledge the uncertainty. Predicting future severity and frequency is a real challenge.
Yeah.
You've got factors like potential tariffs impacting parts costs, used car price fluctuations, ongoing repair cost inflation, evolving driving patterns. Lots of moving pieces.
Absolutely. So while personal auto has its own set of variables, let's turn our attention now to commercial lines.
Okay.
This seems like a different kind of market dynamic. You mentioned even policy growth doesn't always translate directly to written premiums here.
That's right. It's an interesting segment. Covers things like core commercial auto for businesses,
Right.
Transportation Network Company, or TNC, Business Think Uber,
Yeah.
Lyft drivers insurance,
Got it.
fleet and specialty lines, and business owners policies, BOPs. Core commercial auto is the big piece, though. About 80% of the net premiums written in this segment.
80%. Okay. And yeah, it was interesting because commercial lines saw NPW decrease 6% in Q2,
Decrease, yeah.
despite PIF, policies in force, growing 6%.
Exactly. Seems counterintuitive, doesn't it?
It does. What's the explanation for that? Why would premiums go down if policies are going up?
Well, the decline in MPW was primarily due to some specific changes in policy terms and renewal timing for certain TNC business policies.
Okay, like how?
For example, they mentioned a scenario where maybe a large TNC customer moved from a 6-month policy term to a 12-month term late last year, say in Q4 2024.
Ah, so that renewal premium wouldn't hit in Q2 2025 like it might have before.
Exactly. It shifts the timing of when the premium is written. There was also a mix shift within core commercial auto itself.
A mix shift.
Yeah, a greater proportion of 6-month policies in certain business segments like contractor and business auto BMTs. Again, lower premium per transaction.
Okay.
And on top of that, decreased demand in some of the higher premium segments like for hire transportation trucking, essentially.
Less demand there.
Due to challenging freight market conditions, if the trucking business is tough, there's less demand for new insurance policies. So it's really about the structure and duration of policies and specific market demand shifts, rather than a wholesale lack of new business.
Okay, that makes more sense. It's not just fewer customers overall.
Right. And on that front, new applications in their core commercial auto actually increased 3% in Q2.
So still growing new business there.
Driven by better, quote, volume and conversion, even despite that decrease in the for-hire transportation segment we mentioned.
And what about keeping those commercial customers? Retention.
Looking positive there, actually. A 5% increase in the trailing 12-month policy life expectancy for core commercial auto.
Well, that's good. Why the improvement?
They attribute it to moderating rate increases, maybe not pushing rates up quite as aggressively as before.
Right.
And also specific initiatives like sending out payment reminders, things to help customers stay on the books longer.
Interesting. So sometimes lower rate increases can actually help retention and the bottom line.
Seems to be the case here, yeah.
And to keep things competitive, they did take some rate.
Yes, a 3% aggregate rate increase in core commercial auto during Q2, bringing the year-to-date increase to 4%. So still adjusting, but perhaps more moderately.
Okay. And they're also rolling out a new model.
Yeah, a new 8.3 model for improved segmentation, trying to better match price to risk. And they mentioned a new Cargo Plus endorsement product as well, so always innovating on the product side too.
Okay, let's transition now to their investment operations. This seems like a pretty significant engine driving overall performance, right?
Absolutely. You can think of the insurance side generating cash and the investment side putting that cash to work.
And it's a lot of cash. The fair value of their investment portfolio increased to what, $88.6 billion?
Yep, $88.6 billion at June 30, 2025. That's up from $80.3 billion just at the end of last year, December 31st, 2024.
Wow. What drove that growth? Just the insurance premiums coming in.
That's a big part of it, positive cash flows from the insurance operations, but also strong investment returns helped grow the pile.
So they've got this massive pool of money. How are they actually putting it to work? It really is like this giant investment engine running in the background.
It really is. Think of it as the quiet powerhouse. Their pre-tax recurring investment book yield, basically the income generated by the portfolio before considering market value changes, was 4.2% for Q2.
4.2%. How does that compare?
That's up from 3.9% last year, so earning more income on the portfolio.
Why the increase?
Primarily because they're investing all that new cash coming in and also proceeds from older bonds maturing into newer securities with higher coupon rates, basically taking advantage of the higher interest rate environment.
Smart. Active management.
Seems like it. Maximizing returns where they can.
And what about the overall portfolio return, including market value changes?
The fully taxable equivalent, or FTE, total return was 2.1% for Q2,
Okay.
which is a solid increase from only 0.9% in Q2 last year.
How did that break down between bonds and stocks?
The fixed income portfolio returned 1.7%, but the common stock portion delivered an impressive 10.9% return in the quarter.
Wow, 10.9% from stocks in just one quarter. That's really eye-catching.
It is, but important to remember their overall strategy here.
Right. What is their allocation strategy?
Progressive maintains an asset allocation strategy where they keep between 0% and 25% in what they call Group I securities.
Group I beam.
That's common equities, preferred stocks, and non-investment grade bonds, basically the riskier stuff.
Okay, and the rest?
The remaining 75% to 100% is in Group 2, which is short-term investments and other investment-grade fixed maturities. The safer stuff.
So where were they at the end of Q2? Mostly safe.
Yeah. As of June 30, only about 5% of their portfolio was in that Group I category.
Only 5% in stocks and higher risk bonds.
Right. It shows a largely conservative, fixed income heavy approach, which makes sense for an insurance company, right? They need stable assets to cover future claims payouts.
Absolutely. So their risk management approach sounds quite strategic, quite conservative overall.
It certainly appears so. Within that fixed income portfolio, the duration, a measure of interest rate sensitivity, was 3.4 years.
Is it high or low?
It's well within their target range of 1.5 to 5.0 years. Interestingly, they said they actually increased duration during 2025
Why would they do that?
to capitalize on those higher yields available on slightly longer-term bonds, locking in better income.
Okay. And credit quality. Are they taking risks there?
Doesn't look like it. The weighted average credit quality of the fixed income portfolio is A.
AA. That's very high quality.
Very high. Indicates a high-quality, low-risk bond portfolio, aligning with that conservative mandate.
What about liquidity? Can they get their hands on cash quickly if they need it for big claims events?
They seem to be in a very strong position there. The portfolio is highly liquid. They hold $48.9 billion just in short-term investments and U.S. Treasury securities.
That's almost $50 billion.
Yeah, that represents 55% of their entire portfolio. So plenty of readily available cash to cover claims and other short-term obligations, pretty much no matter what.
That's reassuring. Now, digging into some specific asset classes, fixed maturity securities, bonds, were they still showing losses due to past rate hikes?
They're doing much better there. Total net unrealized losses, meaning losses on paper, not yet sold, reduced significantly, down to just $4.1 billion after tax in Q2
From
$1.7 billion in unrealized losses back in Q2 2024.
big improvement. Why the change?
Mostly due to valuation increases as interest rates came down a bit from their peaks and also credit spreads tightening. So their bond portfolio is recovering value.
Okay. They also hold asset-backed securities, right? Mortgages and such.
Yep. They break it down into residential mortgage-backed RMBS, commercial mortgage-backed CMBS, and other ABS.
Anything noteworthy there, especially with CMBS, given worries about commercial real estate?
Well, it's worth noting they reported no CMBS delinquencies at June 30. So at least within their specific holdings, things went healthy in that area at the end of the quarter.
Good sign. And their stock portfolio, you said it did really well. Is it concentrated in certain stocks?
Doesn't seem like it. They mentioned their common equity portfolio generally correlates with the Russell 1000 index.
So a broad market approach.
Yeah, suggesting they're tracking the wider market rather than making highly concentrated bets on individual stocks.
Okay, that covers the investment engine. Now let's look at their overall financial fortitude and how they handle shareholder returns.
Right, the bigger picture of financial health.
They reported strong positive cash flows from operations, didn't they?
Very strong. $9.2 billion for the first 6 months of 2025.
$9.2 billion. How does that compare?
That's a solid increase from $7.5 billion in the first half of last year. So the core insurance business is generating even more cash.
And what does that kind of operational cash flow let them do?
Well, it's really the lifeblood. It directly supports their robust capital position. Total capital increased to $39.5 billion at June 30,
Up from
$32.5 billion at the end of 2024, primarily driven by comprehensive income, basically earnings plus changes in investment values.
and their debt level.
Very manageable. Their debt to total capital ratio is quite healthy, only 17.5% at June 30.
And their policy is.
Their internal policy is to stay below 30%, so they're well within that limit. It indicates they aren't overly reliant on debt and have a very strong balance sheet to absorb potential shocks.
Good position to be in. And they're also returning capital to shareholders. Always good news for investors.
Definitely. They declared quarterly dividends of $0.10 per common share in both Q1 and Q2.
Okay, standard quarterly.
But also remember that back in January 2025, they paid out that substantial annual variable dividend.
Oh yeah, based on the previous year's performance, how big was that?
Huge. $2.7 billion paid out for their 2024 performance. That's a massive return to shareholders.
Wow. Any share buybacks?
Yes. Beyond dividends, they also repurchased about 0.3 million common shares for $67 million in the first 6 months of 2025.
Why hit the buybacks?
They state it's done strategically, partly to neutralize the dilution that comes from employee stock compensation. And also opportunistically when they believe their shares are trading below what they see as long-term fair value. So it shows a disciplined approach to managing their share count and shareholder value.
Now, there was an interesting kind of specific detail mentioned about Florida. Something about a potential profit limit.
Yeah, that caught my eye too. It relates specifically to their personal auto business in Florida. There's a state regulation, apparently.
Okay.
If Progressive's cumulative profit from Florida personal auto over the 3-year period, 2023-2025, exceeds a certain statutory limit,
Then what happened?
then they might be required to pay out some of that excess profit back to policyholders who are active at the end of 2025.
Huh. Like a forced rebate. What's the significance of this? And how likely is it?
Well, it's a pretty unique regulatory quirk specific to Florida. It highlights the complex state-by-state rules insurers have to navigate. As for likelihood,
Yeah.
the document emphasizes it's still uncertain. It depends heavily on factors like, well, the upcoming hurricane season, which directly impacts claims costs in Florida,
Right.
and also how their loss reserves develop between now and year-end. So while it's a potential payout they have to disclose, it's far from a guarantee at this point.
Okay. Something to watch, maybe. And like any huge corporation, they face lawsuits, right?
Always. They mention ongoing class action lawsuits challenging a couple of practices.
Such as?
One relates to how they value total loss claims, specifically using some kind of negotiation adjustment in multiple states.
Okay.
And another challenges how they calculate personal injury protection, or PIP, benefits.
Are these a major financial risk right now?
They state that their current accruals, the money set aside for potential losses from these, are not material at present.
What?
But they acknowledge the potential for material adverse effects down the road if the results from these cases, in aggregate, turn out unfavorably. It's just a standard risk disclosure, a reminder that even successful companies face constant legal scrutiny.
Understood. Okay, shifting gears a bit now as we near the end. It's fascinating to look beyond just the numbers and see how their culture and leadership might contribute to this success.
Absolutely. The softer side, but often just as important.
They seem to manage expenses pretty meticulously. You mentioned advertising spend was up a lot.
Yeah, ad spend increased 35% in Q2. That's a substantial investment in growth.
But they offset that somehow.
They partially offset it with decreases in other areas, like general non-acquisition expenses. It suggests they're making targeted investments where needed, like advertising, while still finding efficiencies elsewhere. Disciplined spending.
And the CEO's letter included some anecdotes, right? Illustrating their company purpose.
Yeah, they shared a couple of powerful examples that really bring Progressive's stated purpose, helping others move forward and live fully to life.
What stood out to you? These aren't just feel-good stories, are they?
No, I think they illustrate a culture. For instance, they highlighted Heather, an employee in commercial lines claims.
Okay.
She and her team used Progressive's volunteer time-off policy to go pack food for students in need in their community.
So the company enables that kind of community involvement.
Exactly. It reflects their values in action, empowering employees to contribute.
And there was another one about a claims rep.
Yes, Ashley, a catastrophe claims rep, I think in Texas. After a storm, she apparently noticed customers were really struggling to get basic necessities.
Yeah.
So she actually went out and bought and distributed food, water, hygiene items herself, showing incredible empathy and initiative during a crisis.
Wow. That really speaks to a culture that trusts and empowers its frontline people.
It really does, going above and beyond the standard claims process.
And finally, the letter also mentioned former leadership.
Yes, the CEO paid a heartfelt tribute to the passing of former CEO Glenn Renwick.
Okay.
She emphasized his profound commitment to the company's core values and his lasting impact. It really highlights how leadership, past and present, shapes a company's identity and ultimately its long-term success, a testament to that legacy.
So wrapping things up, you, listening, should now have gained a pretty comprehensive understanding of how Progressive managed to achieve that strong trifecta in Q2 2025.
Yeah, from their impressive growth in policies and premiums right through to their strategic investment portfolio.
And even touching on the culture that seems to underpin their operations.
It's truly fascinating, I think, to see how a company of this scale meticulously manages all those pieces. You know, the top-line growth, but also the really intricate details of claims, investments, product innovation, and employee engagement, all to drive financial success. They're clearly operating with a very sophisticated playbook in a highly dynamic market.
Absolutely. So as we finish, maybe a final thought for you to consider. As we continue to see these dynamic shifts changing consumer behavior, external factors like, say, trade tariffs potentially influencing repair costs, new regulations popping up.
The landscape keeps changing.
What further innovations or strategic adjustments might Progressive, and maybe other industry leaders too, explore to maintain this really delicate balance, that balance between growth, profitability, and customer satisfaction in what seems like an ever-evolving market?
Yeah, that's the billion-dollar question, isn't it? How do you keep all those plates spinning successfully? It's definitely something that keeps the industry constantly adapting and innovating.